Sivels, Director of Education and Community Engagement with Community Investment Corporation. We are super excited to be here today. I love it when folks get together to talk about investing in real estate, right? Great. So just quick short agenda about what we're going to talk about today. We're going to do our introductions. We're going to talk a lot about CIC and what we do. We're going to focus on our multifamily product, even though we have other products within our company, but we're going to focus today our conversation around multifamily. And then of course, we'll let you guys ask some questions. So a little overview about CIC. Is anybody familiar with Community Investment Corporation here in Chicago? A little bit, all right, a lot of it. Any CIC clients in the house? Almost there, all right, that's great. Great, good time to be a CIC client because a lot of folks, they want to invest in real estate. So we are a local commercial lender. We're CDFI, meaning we are a community bank. We focus our primary transactions are multifamily, meaning anything 5 units and up. And then Katie, she'll talk more about our individual types of units that we lend to. We're mission-based. A lot of people, they get it. We are a commercial bank first, but we also are a nonprofit as well. However, we are a stronger lender in tougher areas that need that community support. So we have a good mix of what we do. Like I said, who am I? I've been with CIC actually for 5 years. Today is my 5th year anniversary with CIC. I know me and Katie, we actually started at the same time. I think she's a little older than I am, but today is my 5th year anniversary with CIC. Prior to that, prior to CIC, I used to work for the Chicagoland Apartment Association. There I was a senior manager for education. So this is an industry, right? Property management is an industry. It's a very profitable industry as well when you mix it with becoming an investor as well. So I'll let Katie introduce herself real quick before we dive into the program.
Good afternoon, everyone. I'm Katie Elmore. So Jessica and I are in the same team. We're actually in the communications team at CIC. Jessica has been managing community outreach and property management training, and I'm helping CIC launch new programs and do business development. I actually managed our energy efficiency program before this role, so I can talk to you all about energy retrofit, sustainability, all that, climate change. We can hit that if you're interested, but we're here to do business development and network and tell you all about CIC. So I'll turn it back to Jessica.
Okay, so we do have a presentation together, and again, we'll give you guys a copy of this. So, and of course, you can always go to our website, cicchicago.com, to get more information about what we're going to talk about today. So like I said, we are a multifamily lender, a CDFI. What is that? A certified
Community Development Financial Institution.
There you go. So this is pretty much our mix. So of course, financing, that leads what we do. We also have community development and technical assistance. That's what I do. Actually, I should have talked a little bit about more what I do. So when you guys are deciding that you want to become landlords in the city of Chicago, and I'm assuming that all of your properties are going to be in the city of Chicago, right? Mm-hmm. Maybe. Not so much. Well, anyway, I was about to say, well, we're in the city of Chicago, right? And the city of Chicago, they have a wonderful landlord ordinance that we just love as being investors. And so what I do, I actually come out to different communities and educate new investors about how to manage their properties, just so they can understand on a basic level on what to do and what not to do, manage tenants, do marketing, fair housing, and all those good things about supporting your investment. So that's pretty much my primary. When I was hired at CIC, that was my primary role, to do property management training. And now I've been they added community engagement. So again, I'm around a lot. And then we also have a policy arm. That's our, it's called the Preservation Compact, because again, we're mission-based. And a part of our mission is that we believe that you can preserve the affordable housing stock in the city of Chicago. So we're gonna focus on today, like I said, we're gonna talk about our multifamily lending as far as our loan product. We're gonna focus a lot on that today, and how have a little conversation on how you transition from that, I would call them, I call them resi-mercials, but folks who want to transition into multifamily investing. Again, property management training. This is just a mix of how CIC it's made. Like I said, property management training that falls under our community development and technical assistance, which is property management training, code enforcement, and then of course acquisitions. So a lot of people ask, and this is just a sidebar, does CIC sell buildings? We do kind of. We're not going to talk about that today unless you got a question about what does that kind of mean. We don't have a lot of inventory, and it's a special circumstance on how we get the actual property and sell it. And it's tied to a lot of interesting stuff with the city of Chicago. That's the best way I can say it. And then of course our preservation compact, that's our policy arm. So I'm gonna let Katie get into multifamily.
Okay, so, we understand a lot of folks are in the smaller 2 to 4. When you're ready to step up to the 5 units, we're going to talk a lot about multifamily lending and our products for making that transaction. So just the basics of our multifamily loan. So you have the sense of this product. The term is 10 years, the amortization 25. We will loan up to 80% loan to value. That's a 20% equity. Some of our programs we'll get into actually can go higher than 80%, but that's pretty standard. 1.25 debt service coverage ratio. All of our loans are full recourse, and there's a list of eligible properties. So we are looking for that 5 units. That can include an ADU, a basement unit, mixed use properties. So if you have a retail storefront with at least 5 residential units above, that's perfectly great for CIC. I don't know if anybody here is into co-ops, but we do co-ops. SROs are single resident occupants. They're typically very low income housing, and if you are looking to make a transaction, CIC has done lots of SRO lending. And then we have some other products. So that's our bread and butter. We do, obviously, we're based in Chicago. We've done work on the north side, south side, west side of Chicago, but we're also active in the suburban communities. So if you're doing business in McHenry, Lake, DuPage, Will, Kane County, we can also, we can help you there. As Jessica mentioned, we actually specialize in neighborhoods that have historically been disinvested, have a lack of access to capital. If you look at our history at CIC, we did a ton of work in Edgewater and Uptown when those areas were really struggling. We're not as much in need on the north side as much, but we still do lend in Rogers Park in those neighborhoods. Most of our work now is on the south and west side. We're not restricted. That's just usually where we need to fill a financing need, and that's where we are most specialized. So, getting to know our borrowers, most of our borrowers, you guys would fit the bill, small, local, mom and pop businesses. And actually, this is a really important housing stock. Jessica mentioned we're really interested in preservation and affordable housing. A lot of people, when they hear affordable housing, they think big tax credit deals, subsidized vouchers, all of that. But most housing in our country and in Chicago is owned by small businesses, people who are renting out a unit in a building that they own. And so that's what we're focused on, and that's who we try to do business with. I mentioned affordable housing. That does not mean that we restrict rents. There are some programs that we might have a partnership with the city or another funding source, and they might require some kind of low income or tenant verification. But most of our regular loans, the multifamily loan I mentioned, is completely, you are in charge of your property. There are no restrictions. Okay, so again, just going through the list of properties, it is 5 units. Again, you can have that retail storefront downstairs. I didn't actually get into construction. Many of our borrowers are doing rehab. So if you are in a more lower, to moderate income neighborhood, and you're dealing with a building that is, vacant, needs a ton of work, that's what we do all the time. Big gut rehabs are our specialty. We have an in-house construction team. So they'll sort of go through that process from start to finish, review your construction plan. We fund out the draws as you complete. So a lot of people will do a rehab construction and we roll that right into your permanent loan. So you don't need to refinance if you don't want to. You can just do the rehab right into your long-term loan. And the last thing, I know a lot of folks are in that 2 to 4 or 1 to 4 space. If you have a portfolio that comprises 9 units, so if you own 10 homes on a block, you could actually refinance that all in a package with us. That was a really big deal in the 2008 crash when there wasn't a big demand for homeownership. So we really wanted to provide something for investors to be able to make, stable homes for neighborhood residents who were maybe renting and not owning. Now there's a big home ownership market. We might not need that product, but if it's something that interests you, we can send you to a loan officer. Okay, so if you're moving from that smaller, 2 to 4 space, you're dealing with residential lending. This is a commercial loan, so we are not going to, well, of course, we'll look at your credit history at some point, but this loan is not based on your personal credit history. It's based on the building. So when you come to us, we want to know about your management experience, your business plan, your construction plan, who is your GC, all of that, less so than your personal credit. We're not going to be making a loan to you as a person. We'll be making a loan on the building. And so, these are some of the things that we're going to look at when we're underwriting a transaction with CIC. Okay, just getting into that, neither Jessica or I is actually a lender, an underwriter. So I'm not going to provide you a ton of feedback on your specific choices. We'll send you to a lender to have that conversation. But these are some things that you should think about for yourself. The location, the unit mix, obviously the price, and your appetite for construction and how much that's going to value out at the end. You should probably be in a neighborhood that you are familiar or you want to be familiar with. Being a long drive away from your property is maybe not the best thing, especially if you're starting out and you need to be the one that's hands-on. Again, we know property values are really skyrocketing today, so CIC does not want to steer you into a building that's maybe overvalued for the rents that you're going to be getting. So that's something that we would look at with you and hope that you are prepared to be familiar with. Oh, and I'll just real quick on the equity side. Of course, there's an equity contribution. People come up with that equity in different ways. You can have investors, partners, family, and friends. However you get to that equity is on you, but we will, of course, we'll be looking into that in the underwriting process. Okay, ton of text on this slide. I think the main takeaway is this assembling your team. So if there's construction, having that GC with a good track record, with work that we can come and check and see that, that they're performing good work. Let me see what else it says. Yeah, I think the main point of this slide is that network, and we listed a lot of the property owner groups that are in Chicago that, we're new to this group. We've been working with the NBOA, the Neighborhood Building Owners Alliance, for many, many years. So that's typically where we meet building owners. We're so excited to network here and meet you guys, but, creating that team, those partnerships, structuring your plan for your property is really important when you come to CIC.
Okay, we're going to stop here. I know that was a lot of information that Katie talked about. Oh, wait, I'm online, right? So that was a lot of questions. That was a lot of information that Katie just explained. So any questions? We can probably go back a few slides to just clarify a few things, because I'm pretty sure the commercial process of purchasing is it's a lot different than when you purchase your residential. So go ahead, we can. First question.
So will you guys fund the acquisition and the rehab? And we have, how much do we have to do? 25, 20%?
Everything you just said. He asked, will we finance the acquisition and the construction?
Right.
And then how much of a down payment? How much would you guys need for a down payment? So yes, we do. We do the acquisition and construction all in-house. We're very local bank. Well, we are a local lender, sorry. And then your equity, that's what Katie was just talking about. How much money would you need to put into the project? That's typically between 20 to 25,000. Not 20,000%. Sorry to scare you guys, not that much. Well,
Sign me up.
Sign me up.
well, right, no, not that less, I would say. So again, it's 20 to 25% of the project, right? Where do you get that funding source from? It depends, right? Can I pull equity from my house? You probably could if you can pull out cash.
Yeah.
Because again, you have to be liquid. Go ahead.
So the experience that you have when you come to the table and say, hey, I have this much experience, does that have to be in a certain time frame? Like, does that have to be the last 2 years, or could that be over a period?
That's a great question. He asked and when we talk about experience, is there a limit of time? Actually, it'll be the quality of experience for one. And then what have you done? A lot of people let's have a conversation about experience, right?
Yeah.
I bought a house, I'm just hypothetically talking. I bought a house and I did the kitchen, remodeled the kitchen, made it pretty, and I did the bathroom in the basement. Is that really doing actual rehab work? Probably not, unless it included plumbing, electrical. You're working with probably subs at some point, unless you guys are amazing. You know, I understand it's a lot of general contractors out here, but you have to specialize in something, right? And that's another, I can do everything. I need an electrician, I need a plumber. So you need to really niche that down and specialize in something. So with that being said, we don't have a time allotted to say, well, we need to look at the last 2 years of what you've done and experience, but we need to know exactly what have you done with the experience based on your project, because some projects only need cosmetic.
Right.
Some projects don't need, you know, a full cut.
Local or can it be national?
Local would be preferred.
Right. We're going to get into different products that have different requirements, but overall, for a multifamily project, and you're trying to get someone from Wisconsin to come in, but again, they have to understand Chicago. They have, because that would delay your progress. They never work with the folks in City Hall. They never work with the folks down, you know, Department of Building to get permits and all that good stuff. So again, we have your, you know, you guys are our clients, so we have your best interest in mind always. You know, a person, if you hire someone from Florida trying to come in Chicago, that's a different conversation. And I don't think you want that much, you don't have that luxury of time for him to get that person acclimated on how to deal with Department of Building. Who else had a question? Go ahead.
The post rehab value. So we're gonna, our products generally have an 80% loan to value. That would be as complete. There's also a loan to cost calculus. So that could be, you know, sometimes it's 80% loan to cost, sometimes it's something else, depending on how the building appraises and also the product that we're working with. So yeah, post construction rehab. Yeah. So the draws. That, I mean, it would depend on your, so we do the draws it's not like monthly, it's just as you complete, you submit for your draw. So if, you know, if your subs can wait, you could pay them after you get the draw. I mean, I'm not in the construction department to know how everybody handles that, but we would do, like, if you're 8% complete and you submit for a draw, we could pay out that 8%, you know, and it's
Initially.
yes,
Not
yes,
expand.
yes.
But usually
Yeah.
you don't want to pay your contractor before the work.
Actually, right, that comes into play when you identify your team. Because if a team, if you're hiring a general, and again, I'm just talking basic, overall conversation, your general contractor, if they're asking you for 50% of the project, chances are they probably either never did that or they can't fund a project that way. So initially, they might ask you for initial start cash, right? If you need to do some type of demolition, they might ask you for that because again, it's going to be there anyway. And I'm sorry. Materials, it depends too, because if you want to purchase your own materials or if your general contractor is going to purchase, that's something you would need to work out. But again, it's not a long period. If you say you have 8% done, you have 10% done, you contact us, our folks come out. It's not a long drawn out process. We do everything in-house, meaning we don't have to wait for a check to come from all over.
Yeah.
It's, you come downtown, you show the work is verified, we pay you. So it's a good, clean process, but sometimes in that general contracting space, it can get gray.
I did have a question. So I don't know if this was covered within the experience answer, but if you are like small multifamily owners, so if you have like 3 or 4 buildings that are 3 to 4 units and you wanted to kind of scale up higher, would you take that experience into consideration in terms of management and rehab? And then I forgot my second one.
Yes, everything. Well, she asked, well, would we take your management experience in your current state if you own or you're renting 2 to 3 units, even if you're doing a 2 flat, if you're self-managing, that's considered experience. even if you're gonna hire a property management, I don't wanna get on my property management soapbox, but I can. If you hire one, you still need to understand what they're doing. Again, we talked about that ordinance a little bit, and if you guys wanna come and take my property management class, that'd be great. No, go ahead. Another question.
By the way, I did take that back. That's a question. One, interest rate. So when you have to reserve 5%.
Oh, that's a question I don't know the answer to, but I can tell you that we have a 3-year ARM and a 5-year ARM, our multifamily products, the first mortgage program. And our rates are what the local banks are offering. So, you know, we have a very thorough underwriting process, this conversation about experience, of course, but in terms of our rates, it's very much similar that you would get at a Wintrust or a local bank. Yeah, 10 risky, yep. I don't think I've seen him since we had like parties in person, so.
It's been a couple of years.
Yeah. You mean buildings that we're selling, that kind of thing? So Jessica alluded to that. We sometimes have an inventory of buildings. I don't really know that we have an inventory of multifamily buildings right now. We have somebody who does that for a single family, but it's a different process and it's kind of involved. So yeah, probably less inventory in our. I mean, we do still have some. I mean, we do the community development side. We sometimes acquire buildings that are for sale. Maybe.
I think he's talking about like Marie Gold's building.
Yes. Okay, so the question is, after construction, do we do another perm net? So everything is one transaction. So you can come to us with your construction, plan, and we'll approve you for your construction period and your long-term debt. And during construction, you're going to pay interest only while you get the project done and you get your construction draws. When you're complete and you're rented up, then you just roll into your permanent. And then if you wanted to refinance, you can with another lender if you want to. Most people just hold it with C.I.C. and until they need to refinance. Yes, during construction, interest only. I mean, you and our construction department, you will propose your construction plan, including your timeline. We will suggest a contingency if you don't have one. And then, there are penalties for not completing your construction on time. So you'll want to work with us to get that done.
And we have realistic timeframes. So it's not like we're not hard money. So we're not saying you got 90 days to turn this project around. No, we understand the process. We understand delays. So sometimes, just again, I'm talking general, that you could possibly be working on a project for a year.
Yeah.
We understand that. That's a good thing about us being a local lender. We understand if you're having challenges with your general contract, you have to find another one during the project, or you have stall time with the city. It can be pulling permits, it can be getting zoned, it can be whatever. We understand that because again, that's the value of, that's the CIC difference.
Yeah, 6 to 18 months is probably typical, but yeah. Okay, any other questions?
Yeah. Yeah. So yeah, he asked the question, will we go ahead and underwrite him without a building? Pretty much, that's what he's asking. It's different. That's why I always explain to people, like typically when you purchase your home, they want you to go get funding first before you even go look at a building, even look at a home, right? They want to make sure that you have pre-approval, you have your documentation. It's totally different in commercial real estate. We want you to identify a building, right? If it's a mixed use, if it's multifamily, you have to identify something for our loan officers to help you underwrite, or they can actually walk a building, let you know the value. They do, again, we do a lot of hand holding which is a good thing because again, baby steps. This could be your first multifamily or your second one because your first one bad. So we are there to walk you through that process. So you need to identify that first because a lot of people want to know, well, what does my credit score look like, right? What does, do I have to be, we do look at your credit, but it's the building that has to cash flow. That's kind of that is the difference. Our largest, I think we max out in funding 7 million. Is it 5 million? 5 million. So it's not a building number. It's not. It's a max loan amount. Your portfolio. So you can have multiple buildings. So it's not a one building. It'll be your portfolio. You as a investor can max out 5. It's 5, 7.
Yeah, I mean,
that's your overall loan. You being that's your overall package. So we have folks who have properties on the west side, property on the north side, some are in construction, some are full service. It can't exceed over 5 million. Yes, yeah. The lending amount.
And is it Chicago land, like you do Austin, like all the
yes.
the iconic colors?
Yeah. Okay. So real quick, we're gonna finish our slides real quick and get back to our loan products. And I'll let Katie talk about that a little bit. Oh, you don't want to talk about the rest of it?
Okay, I can run through this real quick. So we talked a lot. We're mostly focusing on our multifamily loans. I mentioned the 1 to 4 unit portfolio. So that's, again, if you had 10 homes on the block and you wanted to refinance them together, we could do that. 3 free flats. The unit package has to be 9. So our mezzanine debt program is actually a program for those stronger neighborhoods. So if you're, in Oak Park or Hyde Park or on the north side, we can actually take you up to 90%. So you'll have your first mortgage, you'll have your mezz debt that goes up to 90%. That puts your equity down to 10. And there's some favorable rates there, and we do ask for an affordability limit. So that's a little bit of a different program. But if you're in a strong market and you need to lower your equity, we can talk about mezz debt. Agency debt is another program that's for like no construction stabilized buildings. That's your Fannie, your Freddie, FHA. We have a loan officer that can connect you to those programs. Then the last two, Woodlawn and TIF, are programs with the city. So there is a special program just in Woodlawn for a very low construction interest of 2.5%. So typically your construction interest is going to be 6, 7, 8%. This would be 2.5%, but it's only in Woodlawn, and there is required affordability on that. And then TIF, another program with the city, is a grant. So if you are on a really important corridor in one of the TIF Invest Southwest areas, we can give you a grant to cover half of the development costs. So these are really targeted programs that I don't think we should get into because we should really have a more focused conversation on those. Okay, so again, we just want to go through with why choose CIC. We are focused on the small businesses, the local businesses, those that are owning and managing the core of affordable housing in the city and in our country. Okay, I wanted to point this out. These are just some screenshots from our website, but the gentleman had asked, if you don't already have that building identified under contract, you just want to know if you can work with CIC, go to our website and the how to apply and look at the loan submission guidelines and checklist. It's a 1-page form. It says almost everything that we're going to ask from you. So that includes your management plan, who is a partner, what investor partnerships do you have, who is your GC, all of the documents that we're going to ask for are on that checklist. So if you look at that and it makes no sense, then, brush up and, when you're ready and you understand everything that's on that sheet that we will ask you for, and you have a building, that's where you should start. This is just more about CIC. If you're seeing our name, we do intervention for those really, really badly managed buildings. We work with the city to get bad buildings under better management. We've also had a long track history of taking condos. So we also had a question about, can you buy a building from CIC? There have been, especially during the 2008 period, condos that just completely failed, and we helped deconvert those condos and turn them back into rentals. And some of those properties we end up selling. So, you could talk to us about buying properties from some of these programs. And I do just want to mention, Jessica covered our policy work, the ADU pilot program from the city, as well as a new tax incentive program that is really great to get your tax assessed value lowered. Are two programs that recently came out of our policy work. If you aren't going to become a borrower with us, you can still follow our work on policy, because that can benefit you as a small owner or as a real estate broker or whatever your role is.
Katie, what's an ADU?
Oh, an ADU. Typically, ADU stands for accessory dwelling unit, and it's like a basement unit or a carriage house. The city actually calls it additional dwelling units for some reason. So it's adding a unit onto your property that typically, has a 6-flat maybe with another carriage house in the back. Thanks, Jessica.
Yeah. Any other questions? Go ahead.
New construction at all, or?
Yes.
Let's talk about new construction.
Yes, so we absolutely can do new construction. We just approved I think it's a 9-unit new construction in Evanston last year, which was a really, new thing for us. We did sustainability. They went beyond the green ordinance that they have in Evanston, so that was exciting. We don't have a ton of new construction, but we can do it. We expect to do more in the future. The Woodlawn program is also for new construction. So we have people who are going to be building 3 flats in Woodlawn financed by CIC.
The affordability housing, what percentage of the property has to be affordable housing, and what do you define affordable housing as in terms of rent?
Okay, question is about affordability, what defines it and what's required. Most of our loans do not have any affordability restriction. If you get a first mortgage with us, a construction loan, even the 1-to-4 portfolio, there's no limits on the rents that you will be able to collect. The only programs that have affordability restrictions are the city programs, like the TIF program. That is a city grant. So the city is going to want to check your rents. The mezz debt one, which is that, added up to 90% to lower your equity requirement, that one has an affordability. And I think it's like a third of the units are affordable at 80% AMI, something like that. And that's typical. So it'll be a portion of the units affordable at between 50 and 80% AMI, depending on none of them are going to be like the full building is income restricted. That's never, we don't have any programs like that.
Other questions? You got to ask us something else. No,
What terms are we seeing on the mezzanine that you guys have?
oh, mezz debt. That's a sophisticated loan.
I do not know. It was like 7% for that mezz debt portion, but because this program was developed several years ago, and at the time 7% was pretty attractive, and maybe it will become attractive as rents go up, but I think they've worked to lower it. I just don't know where it ended up. But again, mezz debt is really specialized, so we got to send you to our own webinar on mezz debt.
So let's talk about management, right? How many people self-manage right now? How many people want to hire a management company? How many people want to become a management company? Maybe. Well, great. It seems like we got a lot of mix. And again, that self-managed piece is critical. Oh, wait. Oh, okay. That self-management piece is critical, right? Because again, you need to know, you need to have a hand on your property. A lot of landlords, and I get it, they're excited. Well, I'm gonna, purchase that property. I'm gonna give me some tenants. I'm gonna charge them $2,500 for rent because I'm putting a jacuzzi tub in here and they're gonna pay it. They're not gonna tear up my property and they're gonna be great. Well, let me tell you about people, right? And situations happen. Because again, people have aspirations. I want everyone to be a profitable investor, right? That's the name of the game. The game is not to break even. We want to make money, a return on our investment. We want to do all those things. However, you're still dealing with people. When COVID happened, right? That it was a multiple things that came to play. One, we didn't know what the world was going to do. Two, we didn't know, it was more of an economy wake up because again, people being able to afford to pay their rent. I want you to be mindful of that when we purchase our new buildings and we think about, our tenants, because it's a mix of things. Yes, I can afford a building. I can go buy that building. I even have enough money to GC it myself. You know, that's great that you have savings and all that good stuff. Then again, you're on the flip side of that, you're thinking about people, right? The economy is shifting. We're not out of COVID yet. I don't care what anybody says. We're kind of in it, you know, not necessarily that we were 2 years ago, but we're still in it because the economy is still faced with that. And their affordability has changed, right? Hospitality, I always use that as a good example because it rocked, it shook hospitality, right? People are not, the hotels are still maybe 50% occupied, but those are jobs, right? It used to be general managers of those Sheratons, Hiltons, Hyatts. Now they might have other, you know, it took a devastating toll on folks' ability to pay. That's all I say, because again, I hear it all day long. Landlords call me, Jessica, my tenant, you know, the rent was $1,200, but they can't afford to pay it, so I want to kick them out. I don't like to get on my soapbox about property management, but let's talk about this a little bit, because again, you're dealing with people. Not that you have to be sensitive. Well, you do need to be kind of sensitive, but aware of this, especially with your planning, because some people, especially the smaller owners, if that one unit doesn't pay rent, that's, I mean, you're pretty much like, how can I do this? Because again, you purchasing that unit was based on that tenant's ability to pay. When COVID happened, if you got 2 units, they got hit the worst because it's you. And now the person is just like, well, the owner is just like, well, now I have to pay the full mortgage. I hope you had enough in reserves to cover that because, you know, yeah, emergency rental assistance came into play this year and last year a little bit. That helped, but we're still in the Band-Aid, right? We're still in the Band-Aid phase. I don't think it's any more funding available, but again, that was a real situation with, you know, with evictions, with working with tenants, with working with property upkeep, because that was the first thing to go when people decided where am I going to cut back? First thing was snow removal. And then it snowed. Remember in 2020? It went crazy. Everybody, oh my God, they were overpaying to get their snow removed, $300 for your front porch. Because again, that was the first thing they cut. The second thing was lawn care. Well, and I mean, it was so many things you're thinking, how can I, you know, cut back on certain services, but still provide people decent housing? It's a lot of that that you would need to take into consideration when you're thinking about property management.
Your individual classes.
Yes, so I do have individual classes.
Topic.
Yeah, so we have our full certificate class, shameless plug. It's on CICchicago.com, that we educate you on a basic level on how to do the management. And then in our single topics, those are classes outside of the standard workshop that we cover various topics. We just had one on, no, that was policy though.
Tax incentives.
Yeah, we had tax incentives.
Tax.
But yeah, taxes, yay. But we have various topics on screening. We have fair housing. That's coming up. Fair housing month is April. So I will have a lot of, I work a lot with CHA. No one asked about CHA, right? That's a good tenant source because again, I call it the financial aid of housing. They pay. When COVID hit, they didn't stop. And actually they were able to increase. So have a mix. Think about that too when you think about your types of tenants, because again, some voucher programs, and again, I'm going to get deeper into having other conversations with different type of agencies, because CHA is not the only player in town that have these subsidy programs that can offset, you know, with your tenants, and it's a lot of interesting space right now, rental housing. So, question.
I don't have a question, but honestly, I actually took her class years ago. It really is a good class, seriously. They talk about like what's going on with the laws, what's going on with taxes, what's going on, you know, all the current stuff. It's a really, really good course to take.
Thanks. It looks like the next one is on the 29th.
I got a lot out of it.
Yes, that's in person. That's my first class since 2020.
April 29th.
April 29th. It's April 29th. It'll be my first class in person since 2020. So I'm excited. It's almost settled too. But again, baby steps. I got to see, one, will people come, and they're coming, they're registered for it. And then two, to see, you know, how it's going to work, because it's a lot of information to cover and it's a full day. So we cover a lot of stuff in one day.
University, where are you doing now?
We still do it all over. So our classes are all over. I'm trying to hit as many different community spaces as possible, just to get different folks out. So again, north, south, east, west, I'm everywhere. And that one's gonna be on the west side. Any other questions?
What's the cost?
The certificate class is $50, but again, we're still Zooming. So a lot of the single topics are still, they're available for free that you can just watch at no charge. But the in-person class, that is a $50
And you
one
get a
time.
certificate?
Yeah, you get a certificate. So it's not a designation, it's not a certification, it's a certificate, but it's a valuable certificate because again, it coincides with a lot of lenders. They require you guys to have some type of property management education, and that certificate fulfills that requirement. So it's valuable. I tell people, don't lose your certificate. No, I'm just kidding. I get it now. Any other questions? Want to go buy buildings today?
So just to kind of summarize the whole acquisition into your long-term fixed rate
Yeah.
debt, right? So it sounds like you would acquire this property, you guys land at like 75-80% loan to cost, right? And that acquisition debt is adjustable rate.
Yeah.
The arm.
3 or 5 year.
3 year, 5
3 or 5 year adjustable rate.
Yeah.
Right, and then potentially vesting debt.
Oh, yeah.
Right.
Potentially only on certain projects.
Ownership project, right? So then at the completion of it, it was already pre-established what that ARV was going to be at the beginning of the project. So that once that's determined, regardless of what happens in the market throughout, let's say that project takes a year, will those terms still be good at
Yes.
the back end?
It goes to full servicing, and we do that in-house too.
And is that long-term fixed rate that it's not going to be, you're not refinancing, it's just like a rate term change then? Is that what it is? Or are you guys actually
At the
at the completion?
after the
long-term
10-year
debt?
term, yeah, then you refinance with us, with someone else.
But no, it goes to permanent servicing.
Yeah.
That's what you're
Yeah,
talking
yeah,
about.
yeah.
Yes.
Yeah.
So once the construction, because you're only paying, so did you guys catch that? when we talked about our construction period. So say for instance, you purchase the property, right? You get the acquisition, you do the construction part, you need some major construction work. During that period, we're only charging you interest on that debt. But until it's completed. And once it's completed, then we go to full term servicing. So yeah, at the initial startup. So that's a good thing.
And all of that is set prior to the start of construction. All of these
Yes,
terms are set
everything, yes.
Yeah.
regardless of what the market happens. So pretend property values plummet, but we know that this is what it would have appraised at that time when we purchased the property. Would that affect the loan at all?
No. I mean, there's no prepayment penalty. So if you wanted to refinance somewhere, you can. I don't know that you can during construction, but after that, sure.
And that's the difference too between us and a lot of banks, because people, banks, well, I can talk about all of them. Bank of America, US Bank, you see, yeah, they want to do affordable housing, or they want to do, but again, you have to understand what their loan package is. Because a lot of those banks, they want you to be fully stabilized. They won't do the construction. They won't even look at you as, if you're thinking about, if it's total gut, no tenants,
Right.
they're not looking at you until at least you're 50% occupied and the building is solid. Again, it could be a chance to refinance then. We're a good starting place. That's how I sell CIC. We're a good starting place because again, we help you to become a good lender. I mean, a good client, borrower. Did I say that right? Yeah. We're creating good borrowers. There you go. I'm on the road. But yeah, that's what we do.
Correct.
Right, it goes into permanent servicing.
Yeah.
Mhm.
Yeah.
Now, but that's on the flip side if it tanks. But what if, that's if the interest rates go up, it can flip the same way. And then it might be an opportunity for you to refinance into a lower interest rate because the market, every day is different. So it's opportunities on both sides.
And this is still recourse.
Yeah.
long-term debt as
Yes.
well, right?
Mhm. Yes. So it's a good time to invest. Who's going to buy an apartment tomorrow?
Wait, some of
Maybe.
them are actually.
So yeah,
I hope tomorrow.
that's right. So yeah, so
You mentioned interest only period.
It's,
What is the most you would do it until now?
I think like 24 months is the longest construction period I've seen.
But that's not always the case. Because again, we don't want you to hold on to if
The
we
holding
see
cost.
you stalling or if you have issues, we're gonna come in. We have a construction department that they're gonna come in, evaluate to see what's going on and say, well, I'm gonna hold off with my construction for another year.
The 24 months isn't because you're lagging. If you have a very ambitious
At
project,
24 months, basically, look at the
yeah, if you have a very ambitious project and we agree that it will take you 24 months, then we'll give you 24 months. If you're just like, I want 2 years to finish a little bit of work, that, no.
Are those payments increasing based on the draw?
Sorry?
Are those payments increasing based on the draw? Like as you complete?
No.
the project, you get more money, you have to pay. more,
No,
higher
so
payments?
right, you don't go into
So it's
full
not-
servicing until it's complete.
Yeah, when, not just when you're complete construction, when you're rented.
Oh.
So 90% is up, 95%.
I think it's something like that. I don't,
No, I don't think it's that high. But I mean,
Can you repeat that?
it depends.
So you won't go into full servicing until your construction is completed and you're leased up to a certain amount.
Is it
Yeah.
based on 40 or 70%?
I think it's a certain percent, but I don't know.
I don't think it's 90. I don't think it's that high because again, it it depends. I'm gonna say it depends. Again, you know, we have to actually underwrite a deal for you guys. And we've done that before. We actually had a class where one of our loan officers came in to underwrite a deal. That was a very sophisticated, interesting class. I don't think I could be able to pull that off. We had so many people in there and it was the best, worst class I've ever had. Because again, when we go into underwriting, you have a loan officer, you want him to underwrite your deal right then. I can't do that because I can't have it. I mean, he can give a general building and underwrite it right in front of you so you kind of understand. But again, all of our documents are there. That's why I tell people the information, it's free. You don't have to pay $199 or $599 to learn how to do this. All of our information is there. The documentation is there. It's across the board. Pretty much, if you can understand our underwriting, you could take that knowledge anywhere. So it's just a great start.
Any other questions, guys?
Well, we had a raffle. I didn't know if you still want to do it.
Yeah.
Free stuff.
In the spirit of
Everyone gets a raffle ticket that one.
so I have one. And then take a picture. And Katie, you want to pull one?
Sure.
Mix it.
Here, wait, we can.
Got a cup or something?
Yeah.
So you have 4 chances to win. And then we want to communicate with you guys on social media, right? So you can tag either Community Investment Corporation or you can tag me. We want you to have fun with the gifts. So Katie, come on, let's.
Should I pick it? You want to pick it?
Okay.
Like, yeah.
Okay, the first one, is it the last 4 digits? 223?
2, 2, 3.
Yeah.
Okay.
Yeah.
Come on up. We're giving out gas cards today.
House always wins,
The
huh?
house always wins, ladies and gentlemen.
And we're gonna come around and take a picture.